Can you handle losing 8 trades in a row? Not once, not rarely, but over and over again, every few months like clockwork. Because if you're trading a 3-1 risk-reward system, that's not bad luck. That's the system working exactly as designed. And here's the part nobody tells you while you're sitting through loss number 6, 7, 8, questioning your strategy, your discipline, even yourself, professional trading firms. They're not playing this game at all. They don't chase 3-1. They don't worship it. In fact, most of them quietly avoid it. Yet somehow the internet turned it into gospel. Never risk more than you can make. Always aim for 3-1 or better. It sounds intelligent. It sounds disciplined. It sounds like what professionals would do. But what if that advice, the one that sounds the smartest, is the exact reason most traders slowly break down mentally, emotionally, and eventually financially? Because this isn't just about math. It's about what happens to your brain, your confidence, and your decision-making when you're forced to sit through loss after loss, waiting for a perfect setup that may never come. And when you actually look at that reality, the 1-1 system doesn't just compete with 3-1, it completely destroys it. Here's the thing nobody talks about. The 3-1 rule didn't come from professional trading floors. It came from content. It's a clean, teachable concept: risk $1, make 3, only be right 1 in 4 times. It compresses beautifully into a thumbnail, a tweet, a YouTube hook. And that's exactly why it spread. Not because firms use it, not because the data supports it, because it sounds like wisdom. But there's a gap between sounding like wisdom and being wisdom. And that gap is where most traders quietly fall apart. Let's talk about something every trading educator conveniently forgets to mention: losing streaks. Not 1 loss, not 2 losses. Those soul-crushing stretches where nothing works. Where every trade stops you out. Where you start questioning whether your edge even exists anymore. These losing streaks aren't rare events. They're not anomalies. They're mathematical certainties, and how often they happen changes dramatically based on your win rate. Let's look at 2 traders, Sarah and Mike. Sarah trades 1-1. She risks $100 to make $100. Win rate 55%. Not spectacular, not even that impressive. Mike trades 3-1. He risks $100 to make $300. Win rate 35%, still above that magical 25% break-even point. On paper, both systems are profitable. And that's exactly where the illusion begins. If Mike is winning 35% of his trades, that means he's losing 65% of the time. He loses almost 2 out of every 3 trades. That's a lot of red in your trading journal. And what happens when you lose 2 out of every 3 times? You hit brutal losing streaks. A lot. 5, 6, 7, 8 losses in a row isn't some rare black swan event for Mike. It's a normal Tuesday. Sarah wins 55% of the time. She's winning more than she's losing. Her losing streaks are shorter, less frequent, and less psychologically devastating. She might hit 3 or 4 losses in a row occasionally, but 8 or 10, that's extremely rare for her. Now here's where it gets interesting. Watch what's actually happening inside Mike's head during one of these stretches. After loss number 3, he's reviewing his charts. After loss number 5, he's pulling up his trading plan, reading through every rule like he might have missed something. After loss number 7, he's on forums. After loss number 9, he's starting to wonder if the market has fundamentally changed. And underneath all of that analysis, all of that searching, there's a quieter question he won't say out loud. Am I the problem? And here's the part that's almost unbearable. There is nothing wrong with his system. This is exactly what a 35% win rate does. This is normal operation. But his brain doesn't know that. His brain has decided something is broken. And once a brain decides something is broken, it stops executing clearly. It starts protecting itself. That's not weakness. That's biology. Research at MIT found that when traders experienced consecutive losses, their bodies responded identically to a physical threat, heart rate spiking, adrenaline flooding the system. But the critical finding wasn't the size of the loss. It was the frequency and unpredictability. A trader who lost $1,000 but once showed moderate stress responses. A trader who won $3,000 occasionally but lost $1,000 repeatedly showed severe stress responses, even though both were mathematically profitable. Your brain isn't a calculator. It's a survival machine, and consecutive losses activate ancient threat detection systems that don't care about your expected value. There's something called reward prediction error. Your brain releases dopamine not when you receive a reward, but when you receive a reward that's better than predicted. Trading at 55% win rate creates a relatively stable dopamine environment. You win often enough that your brain stays calibrated. At 35%, your brain is in a constant state of negative prediction. And repeated negative prediction errors don't just feel bad. They actually reduce activity in your prefrontal cortex, the part responsible for rational decision-making, while increasing activity in your amygdala, your fear center. In plain terms, losing repeatedly makes your brain less equipped to stop the losing. And then there's the deeper layer. Martin Seligman's research on learned helplessness showed that animals repeatedly exposed to negative outcomes they couldn't control eventually stopped trying to escape, even when escape became possible. The same pattern emerges in traders on extended losing streaks. After enough consecutive losses, the brain quietly arrives at a conclusion. My actions don't change what happens. And once you believe that even slightly, even unconsciously, you either freeze or you blow up. You stop trading entirely or you take increasingly reckless trades because detachment has already set in. This is Mike's quiet unraveling, not a dramatic blow-up, a slow erosion of belief. Now flip it. Sarah wins a trade Monday morning. A clean setup executed well, positive result. Tuesday she loses one, but then she wins two. This rhythm isn't just comfortable, it's neurologically nourishing. John Coates, a former Wall Street trader turned neuroscience researcher, measured testosterone and cortisol in active traders throughout the day. Traders who had a winning morning showed elevated testosterone in the afternoon, and that testosterone didn't just make them feel better. It improved their pattern recognition, risk assessment, and execution speed. They made better trades because they had already won. Sarah, winning 55% of her trades, operates inside that virtuous loop most of the time. She might drop two in a row, but then she wins and the feedback loop resets. Her clarity stays intact. Her edge stays expressed. Mike, winning only 35% of the time, spends most of his time in a cortisol-saturated state. Even after a big win, some part of him knows the losses are coming. The winner's effect requires winning frequently enough to maintain it. Without that frequency, there is no loop. There's just tension between trades. Look at the equity curves. Sarah's 1-1 system at 55% produces something that looks like a staircase. Up a step, up two, down one. Not smooth, trading never is, but the trend is readable. There's a shape you can trust. Mike's 3-1 curve is a roller coaster, long descents punctuated by occasional spikes. The overall drift might be upward, but you'd need the psychological composure of someone who genuinely doesn't care whether they make money. Researchers call this variance. There's also a metric called the ulcer index, named, literally, for the stress-induced ulcers volatile equity curves can cause. In backtests comparing identical expected value systems with different win rates, the lower win rate systems produced ulcer index scores 2 to 3 times higher, not because the math was different, because the experience was unbearable, and Mike might abandon his 3-1 system right before it turns. He's been down 15% for weeks. He decides the system is broken. He stops trading it. Then the market trends, and the setup he spent months building catches a move that would have made his entire year. He never sees it. He wasn't there. Sarah never faces that edge. Her curve never gets painful enough to trigger abandonment. She stays in the game. And in trading, staying in the game is 80% of the outcome. This becomes most visible in prop firm challenges. Most structures are similar. A $100,000 account, a 10% drawdown limit, 30 days. Mike, risking 1% per trade at 35% win rate, will statistically lose 20 of his 30 trades. Wins and losses won't distribute evenly. They cluster. There's a very real probability he strings 8 consecutive losses, which puts him at 8% drawdown. He's now 2 bad trades from elimination, and his system is performing exactly as designed. Sarah risks the same 1% per trade at 55% win rate. She wins 16 of 30. Her worst expected streak is 4 or 5 losses, a $4,000 to $5,000 drawdown. Uncomfortable but survivable. She still has breathing room. She can still execute without fear coloring every decision. Monte Carlo simulations confirm this. A 1-1 system at 55% passes prop firm challenges 67% of the time. A 3-1 system at 35% passes only 41% of the time. If you're running 3-1, you're probably buying 2 or 3 challenges before you pass one. That's over $1,000 in sunk costs before a funded dollar. This is also why prop firms in their internal training don't teach 3-1 dogma. They teach whatever produces consistent, low volatility returns, because psychologically broken traders don't generate profit for anyone. There's also the data gap. Mike finds 8 to 12 qualified 3-1 setups per month. After 6 months, he has 48 to 72 trades, barely enough to distinguish edge from noise. Sarah finds 20 to 30 setups per month. After 6 months, she has 120 to 180 trades. She knows what her system does. She can see when it's changing and respond before it's too late. Mike is always one market shift away from not knowing what happened. Now here's what I want you to actually see, and this is the part that usually gets skipped. The 3-1 rule sounds like discipline. It sounds like the kind of patience that separates professional traders from emotional ones. But look more carefully at what it actually creates. A trader waiting for 3-1 setups spends most of his time in anticipation scanning, filtering, rejecting. And every rejection is a micro-decision under the same psychological weight as an actual trade. Every pass on a 1-1 setup is a small reminder that he's waiting for something more worthy of his risk. Over time, the waiting itself becomes a kind of pressure, and when the 3-1 setup finally appears, he's been carrying that pressure, sometimes for days. He enters with more weight on the trade than the math ever accounted for. That's the part the expected value formula doesn't capture. The formula assumes a calm, detached executor who treats each trade identically. But that executor doesn't exist at 35% win rates after extended drawdowns. What exists is a human being under cumulative physiological stress, making decisions in a compromised state, and then measuring those decisions against a system that assumed no such compression. The root illusion isn't that 3-1 is mathematically wrong. It isn't. The illusion is that the number on the ratio captures what trading actually is. It doesn't. Trading is a sustained psychological act. The ratio is a single variable in a system that runs on human biology. And human biology, under repeated negative feedback, changes. It reorganizes around protection. It narrows focus. It starts looking for exits. That's not a personal failure. That's the system responding correctly to the inputs you're giving it. The question isn't how to be stronger. The question is whether you're giving your system inputs that allow it to function clearly, or inputs that gradually corrupt the very process you depend on. Professional firms understand this intuitively. Jane Street's risk-reward on most trades is approximately 1-1. They're not hunting home runs, they're expressing edge through volume and consistency. SMB Capital, DRW Trading, they train for win rate, consistency, and psychological management long before they discuss ratios. The 3-1 obsession is almost entirely a retail phenomenon. It persists because it sounds sophisticated. It makes for compelling content. It gives traders a filter that feels selective and professional. But the firms who actually make money at scale have largely moved past it. I'm not saying 3-1 is always wrong. In strongly trending markets, on higher timeframes, with genuinely clear technical levels, wide ratios can absolutely be appropriate. A breakout from a consolidation that's been building for months might offer 5-1 potential. Take it. Trailing a winner in a strong trend and letting it run from 1-1 to 3-1, that's excellent trade management. The issue is never the ratio itself. The issue is the dogma that you should always be pursuing it, regardless of context, market condition, or what your own psychology can actually sustain. Some traders genuinely have the makeup for low win rates. They trust their system through deep drawdowns without doubting. They have sufficient capital to absorb long red stretches without external pressure changing their behavior. For those traders, wider ratios may be optimal. But for most, especially those with smaller accounts, newer to live trading or navigating prop firm structures, the 1-1 approach at a higher win rate is nearly always superior. Not because the math demands it, because the experience of trading it allows you to remain yourself. The best risk-reward ratio isn't the one with the highest expected value on a spreadsheet. It's the one you can execute clearly, consistently, week after week, without the process itself eroding the capacity to execute. The trader who survives and thrives isn't the one with the most impressive ratio. It's the one who can still see the market clearly after 6 consecutive losses, because 6 consecutive losses is the worst it usually gets for them. Not 10, not 12. Not the number at which the brain stops trusting itself. Stop chasing impressive-sounding setups and start building systems you can actually inhabit. Test both approaches with real data. Be honest, genuinely honest, about what losing streaks do to your thinking. Find what allows you to stay clear, not just what looks best in a backtest. Because the best system isn't the one with the highest hypothetical return. It's the one you'll still be running a year from now, with the same rules, the same process, and the same clarity you started with. The professionals figured this out quietly a long time ago. Now you can see it too.